picture this. A retired clothier in Montana is just, working at his shop one afternoon.
Okay.
And a local rancher walks in. The rancher says he wants to buy a pair of boots, but he insists, absolutely demands, that he will not pay a penny less than $100 for them.
Wait, really? $100?
Yeah, and I mean, back then, $100 for boots was just an astronomical sum.
Oh, for sure.
So the store owner, he pulls out his 3 absolute best pairs, right? Highest quality leather, incredible craftsmanship. But the most expensive pair tops out at $89.95.
Right.
The rancher takes one look at the price tag and just shakes his head. He refuses. He actually says, I told you I want a $100 pair of boots.
That's incredible.
Well, I know. So the shop owner takes a deep breath, picks up the $89 boots, walks into the back room, rips off the tag, and literally writes a new one for exactly $100. He brings them back out, and the rancher's eyes just light up. He hands over a crisp $100 bill, and he walks out of the store, completely thrilled.
It's a perfect illustration of behavioral economics, isn't it?
It really is.
I mean, if someone is absolutely determined to overpay for an illusion, well, the market will always provide someone willing to sell it to them.
Exactly. And that dynamic right there, that's the exact reason we're doing this deep dive today. Welcome to the show, everyone.
Glad to be here.
You're tuning in because, you already know the basics of personal finance. You know you're supposed to save money, you budget, all of that.
Right, the usual advice.
Yeah, but you look around and see people operating on a completely different level, and you wonder what the actual structural differences are.
For sure.
The problem is, when you go looking for those answers, you run straight into this financial guru industry that operates exactly like that Montana shop owner.
Oh yeah, they're selling the $100 tag, not the boots.
Okay, let's unpack this. Because if someone actually had a proprietary, fail-proof algorithm that doubled capital overnight,
they wouldn't be selling it.
Right, they wouldn't be selling access to it for a $99 monthly subscription. They just quietly run the algorithm and buy an island somewhere.
Exactly.
Their actual business model is selling the feeling of a shortcut. And we have a massive, diverse stack of sources to unpack today.
We really do.
We've got this 200-page PDF on value stocks, a University of Hawaii academic paper, which is where that boot story comes from, actually, plus a brutally honest Reddit thread on day trading, and articles from the Economic Times on the hidden money habits of the ultra-rich.
It's a lot of data to synthesize.
It is. Our mission today is to cut through all that get-rich-quick noise and extract the mathematically proven and sometimes surprisingly boring strategies that wealthy investors actually use.
And what's fascinating here is that we should probably start by looking at the harsh reality check provided by the people who actually try to find those shortcuts.
You mean the Reddit thread?
Yeah, this massive community discussion from day traders. People who actively try to beat the market on a daily basis.
Right.
You constantly see outsiders asking them, hey, how do people manage to get rich doing this? And the consensus from the people actually in the trenches is just, it's sobering.
Because the reality definitely doesn't match that, Instagram aesthetic of trading from a laptop on the beach.
Not even close. I mean, the professional traders themselves will tell you that day trading is not a get-rich-quick mechanism at all.
Right.
It's a grueling, high-stress, full-time job. Right. You're competing against high-frequency trading algorithms built by institutions with billions of dollars in infrastructure.
Which is terrifying.
It is. To even survive, you need the emotional intelligence of a monk, elite data analysis skills, and flawless impulse control. And even then, the vast majority just fail.
Wait, so is the stock market just a rigged casino for the average person then?
Well, no, and that's the crucial distinction those traders make. It's the difference between having a high-stress job and building wealth. Trading is a job. Investing, on the other hand, is a structural plan for the future.
Right.
For the everyday investor looking to build a massive pool of capital, the math overwhelmingly points to buying broad market index funds.
Like VOO or SPY.
Right. Exactly. Funds that just track the S&P 500, you buy them, and then you literally forget your login for 20 or 30 years.
Basically letting compound interest do all the heavy lifting.
Precisely. As the sources point out, it's significantly easier to build massive pools of capital by earning a steady, boring return over decades than it is to chase massive, sporadic off-and-out returns.
Yeah, that makes sense.
Earning a modest return on a large, growing pool of capital, that's the bedrock of real wealth.
Okay, but let's push beyond that baseline for a second, because sitting in an index fund for 30 years is kind of the eat your vegetables advice of finance, right?
It is, yeah.
It's mathematically sound, but it doesn't fully explain how the ultra-wealthy actually operate in real time. I mean, if day trading is a trap and index funds take 3 decades, how are these individuals acquiring luxury assets and expanding their portfolios so rapidly?
It really comes down to a massive psychological pivot.
Right. Here's where it gets really interesting. Let's look at the Economic Times source, specifically this concept that completely rewired how I view spending. We can call it the Ferrari rule.
Ah, yes. The distinction between buying a liability and acquiring an asset.
Exactly. The rule is super simple. Rich people do not buy Ferraris with their savings. Their investments buy the Ferraris.
And the mechanics of that are fascinating when you break them down. I mean, if a middle-class earner wants a luxury car, they'll save up their personal post-tax income, right?
Yeah.
Hand over the principal amount to a dealership and drive off. But the moment they drive off the lot, the car depreciates, and that principal capital is gone forever.
They bought a liability with their own cash.
Exactly. But a wealthy individual takes that exact same principal amount and deploys it into an income-generating asset instead.
Like a commercial rental property, for example.
Right. That property generates a steady monthly cash flow. They then take that specific cash flow and use it to make the monthly payments on the luxury car.
I'm sorry.
And at the end of the term, they still own the original principal, they own the cash flowing property, and they own the car. The asset funded the liability.
But hold on, to acquire those cash flowing assets at scale, the research points out they use debt. And I want to play devil's advocate here, because aren't we always taught to avoid debt at all costs? Like, cut up the credit cards, owe nothing to anyone.
Well, that is fantastic advice for consumer debt, which is what most people are familiar with, you know?
Right.
Credit card debt used to buy a television is destructive. But the wealthy differentiate sharply between consumer debt and strategic leverage. They use leverage to expand their purchasing power.
So walk us through the actual math of that. How does borrowing money put more money in your pocket?
Let's use a conservative example from the market analysis. Suppose you identify a piece of commercial real estate that generates a 14% annual return in rental income. Now, you could buy it in cash, but that ties up all your liquidity. Instead, you go to a bank and borrow the capital at an 8% interest rate.
So I'm paying the bank 8%, but the building is paying me 14%.
Exactly. You're pocketing a 6% profit spread on money that wasn't even yours to begin with.
Wow.
You are essentially acting as a manager of the bank's capital, and you get to keep the difference. That is strategic leverage.
You're just creating profit out of thin air by structuring the deal correctly.
Pretty much.
And it's interesting because when you look at the portfolio breakdowns of the ultra-rich in the Jason Hartman source, they're surprisingly conservative with this leveraged capital.
They really are.
Like, they aren't throwing it into highly speculative, volatile tech startups as often as people think.
No, they lean heavily into tangible, solid assets, things like real estate, precious metals, and even fine art. They cast a wide global net to hedge against local market downturns. The underlying philosophy is to acquire things that have intrinsic value, things that human beings will always physically need or fundamentally value, regardless of what the stock market ticker says on any given day.
Okay, so they use leverage to buy apartment buildings and art. But for you, the listener, you might not be at the stage where you're, negotiating commercial real estate loans or bidding on a Picasso.
Probably not.
The stock market is still the most accessible wealth building engine. So if we want to go beyond just holding that broad index fund, if we actually want to pick individual companies to own, how do we do it structurally without gambling?
We have to apply rigorous, mathematically proven filters. And we have an incredibly detailed academic breakdown here from Apurva Pellik's PDF of the specific filters value investors use.
Yeah, and before we even get to the complex math of those filters, there's a study in that PDF that absolutely blew my mind.
Oh, the 10-year-olds.
Yes. They set up this long-term survey with 2 distinct groups. Group A was highly trained, elite financial analysts. People who spend all day modeling macroeconomic trends.
Right.
Group B was literally a classroom of 10-year-old kids. Both groups were asked to pick a portfolio of stocks to hold for a decade.
And the analysts completely overcomplicated it, didn't they?
They totally did. They picked complex, highly leveraged derivatives and obscure tech companies, the 10-year-olds. They just looked at what they liked and used.
Simple common sense.
Yeah, they picked companies like Disney, Cadbury, and the company that makes Barbie, brands they physically interacted with. And over 10 years, the 10-year-olds outperformed the Wall Street analysts.
Because at its absolute core, investing really is grounded in common sense. The children just looked at the ground reality of consumption.
Exactly. So for the listener, just look around your own house. What toothpaste are you using? What operating system is on your laptop? If you trust a product enough to use it every single day, and millions of others do too, that company belongs on your radar.
But, and this is a massive but, common sense is only the starting line, right?
Right.
Just because a brand is popular doesn't mean the company behind it is structurally sound. Popular companies can be mismanaged into bankruptcy all the time.
For sure.
This is where those technical filters come in to validate your common sense. The sources outline 11 specific criteria, but let's break down the most critical ones you absolutely need to check before buying a single share.
Okay, let's open the hood. Where do we start?
We start with promoter holding. You want to see that the founder or the core management group owns more than 51% of the outstanding shares.
So they need to have majority control. But why is that specific number 51% so important?
Because it proves they have skin in the game.
Okay.
If a founder owns, say, 75% of the company, their personal wealth is inextricably tied to the long-term success of that business. They are heavily incentivized to work late, innovate, and really protect the company's future.
That makes total sense. Like, if I'm looking at a company and screening a potential business partner, and the founder has quietly sold off their shares and now only owns 4%, why should I risk my hard-earned capital when the person running the place won't even risk theirs?
Exactly. It's an alignment of incentives. If the leadership is committed, the next filter is checking the engine of the business itself, financial health.
Okay.
You're looking for consistent year-over-year growth of at least 20% in both the top line of revenue and the bottom line, which is net profit.
Wait, so if a company is just jacking up its prices because of inflation, it might look like revenue's growing on paper, but they aren't actually expanding the market share.
That is a crucial distinction. The revenue growth must be driven by an increase in unit sales.
Right.
If they sold 1 million widgets last year, you want to see them selling 1.2 million widgets this year. If they're selling the exact same number of widgets but just charging more, that is not sustainable growth. They're totally vulnerable to a competitor who undercuts their price.
Okay, so the founder is heavily invested, they're selling more widgets every year, and profit is up. What's the next metric? Because I know efficiency is a huge part of this.
Right, and that brings us to return on capital employed, or ROCE. This needs to be consistently over 20%.
Okay, let's translate that into plain English. How do I actually visualize ROCE?
Think of it like setting up a high-end coffee stand.
Okay.
If you put in $50,000 of your own savings and you borrow another $50,000 from the bank, your total capital employed, the total size of your financial engine, is $100,000.
So I have a $100,000 engine.
Correct. Now, if that coffee stand generates $20,000 in pure operating profit over the year, your return on capital employed is 20%.
Got it.
The reason this metric is so vital is that it measures management's competence. If a company has a massive financial engine but can only squeeze out a 4% return on that capital, they are terrible at deploying resources.
Right.
You want a management team that knows how to generate a high yield on the money they control.
And part of being a competent manager is knowing how to handle debt, which is another major filter in the research.
Yeah.
We talked earlier about the wealthy using leverage, but when they buy a public company, they want the opposite, right?
No, absolutely. They want a zero debt company or one with extremely negligible debt compared to its equity.
Why the double standard, though? Why use debt personally, but avoid it in the stocks they pick?
Because as a shareholder in a public company, you don't control the cash flow. If a company is heavily leveraged, a massive portion of its operating profit goes straight to servicing interest payments, not to rewarding shareholders or funding innovation.
That makes sense.
Plus, in a high interest rate environment, highly indebted companies can spiral into bankruptcy very quickly. You want a fortress balance sheet.
And that fortress needs to be built on actual cash, not just accounting tricks.
Absolutely. The final major filter is positive operating cash flow. A company can show a massive profit on its income statement through various accounting methods, but if they aren't actually collecting the cash from their clients, they can't pay their bills.
Right.
The research points to major global consumer goods conglomerates like Nestle India or HUL as the gold standard here. They deliver a product, they get paid in cash immediately, and their operating cash flow is massively positive. Cash is oxygen for a business.
Okay, so let's say I do the work. I look around my house, I find a product I love, I check the financials. The founder owns 60%, unit sales are up 20%, ROCE is stellar, zero debt, cash is pouring in.
Sounds like a great pick.
I buy the stock. But then a month later, the broader market takes a hit and the stock price drops by 30%. Every instinct in my body says, this is a great company, it's on sale, I should buy more and lower my average cost.
And the sources issue a strong, glaring warning against exactly that instinct. It is one of the most common ways retail investors wipe out their portfolios.
But if I liked it at $50, why wouldn't I love it at $30?
Because you're assuming the intrinsic value of the business hasn't fundamentally broken.
Oh.
In the institutional world, trying to average down on a plummeting stock is called catching a falling knife. It's akin to jumping onto a derailed train just because the ticket price dropped.
Yikes.
The sources cite case studies of massive finance corporations like Yes Bank and DHFL that looked cheap as their stock fell. Retail investors kept buying, thinking they were getting a bargain, but the institutions were aggressively selling because they knew the core business model was irreparably damaged.
So the dropping price wasn't a discount, it was an alarm bell.
Exactly. Just because something is getting cheaper does not mean it is a good deal. Value traps are real.
Right.
The professional strategy is to average up when a stock proves its upward trend and validates your thesis, rather than throwing good money after bad.
That is a brutal lesson, but an essential one. Okay, so we've covered the mechanics of leverage, and we've walked through the strict structural filters. But acquiring the asset is really only half the battle.
Sure.
The final piece of the puzzle isn't about what to buy, it's about the metagame. It's how the wealthy manage their environment, taxes, and their own psychology.
This is where the gap between the middle-class earner and the ultra-wealthy individual becomes deeply systemic.
We hear it all the time, right?
Yeah.
The rich don't pay taxes.
Yeah.
But looking at the Economic Times source, let's talk about the actual plumbing of how that works, because it's usually not illegal evasion, it's structure.
Right.
The ultra-rich rarely take massive personal incomes. Instead, they route their wealth through holding companies and family trusts.
The structural advantage is profound. It comes down to the difference between pre-tax and post-tax spending.
Okay.
If you earn $1 as an individual wage earner, the government taxes that dollar immediately, and you're forced to live on whatever is left over.
Right. The tax is deducted before I even see the paycheck.
But if a corporate entity earns $1, the rules change entirely. The corporation gets to deduct its operational expenses first.
No.
Travel, technology, property management, legal fees. The corporation pays for its lifestyle first, and then it is only taxed on the remaining profit.
Okay, but how does this help our listener who doesn't have a family trust or an offshore holding company?
If we connect this to the bigger picture, the specific tax vehicle isn't the real takeaway for the average investor. The underlying principle is valuing time over money.
They're optimizing for time.
Exactly. A middle-class mindset says, why would I pay a CPA or a property manager when I can just do it myself and save the fee?
Right.
The wealthy mindset views time as their only truly non-renewable resource. They obsessively outsource because spending a bit of money to buy back 40 hours of their own time is an incredible return on investment.
So for the listener, the direct application of that philosophy is automating their investments.
Yes. You set up a systematic investment plan, or SIP. Automated transfers into your index funds or your vetted value stocks every single month, regardless of market conditions.
Set it and forget it.
Exactly. It saves you the time of logging in, but more importantly, it saves you emotional energy. You don't waste time trying to time the market.
Which perfectly transitions into the ultimate wealth hack detailed in the Mellon Street source.
Yeah.
Emotional mastery.
Emotion is the silent killer of compounding capital. The stock market is a machine that rewards rational, structural thinking and severely punishes reactive panic.
Right.
When the broader market crashes, the average retail investor feels real psychological pain. They panic and they sell their assets at the absolute bottom.
Just lock in their losses to make the anxiety stop.
Exactly. The wealthy, however, have trained themselves to view a market crash as a massive clearance sale. Because they have liquidity ready, they sweep in and buy high-quality companies at a steep discount.
Yep.
As Warren Buffett famously noted, the stock market is essentially a device for transferring money from the impatient to the patient.
Yeah, almost a paradox. The people who are the most desperate to get rich quickly, the ones looking for those $100 boots, are the very people who end up feeding the wealth of the investors who are willing to wait.
It really is.
So bringing this all together, building wealth isn't about finding a magic indicator or a hot stock tip. It's a structural discipline. It's about acquiring assets to fund your liabilities, understanding the difference between good and bad debt, applying rigorous common sense filters, and mastering your own emotions.
It requires a complete rewiring of how you react to volatility.
So I want to ask you directly as you listen to this, take a hard look at your own portfolio. Are you buying assets, or are you just buying liabilities disguised as lifestyle upgrades?
And as you analyze that, there is one final powerful insight hidden in the Economic Times and PSX sources that we need to leave you with.
Oh, right.
It is arguably the ultimate gatekeeper of the ultra-wealthy. We've talked extensively about how to buy public stocks, but the reality is the absolute best investment opportunities never go public. The truly lucrative deals, pre-IPO shares, early private equity rounds, off-market real estate, they are gate-kept by wealth and circulate in closed rooms.
The public market is where founders exit, right? But the private market is where they build.
Precisely. So I challenge you to think about your social capital. Who are you networking with? Because sometimes the most lucrative asset you can build isn't a stock portfolio, it's the financial circle you deliberately surround yourself with.
That is profound. Access really is everything. So keep digging, keep learning the structural rules of the game. And whatever you do, please make sure you aren't paying $100 for an $89 pair of boots. Enjoy the deep dive into your own financial future.